about Winona Canoe for a second. This guy, Mike Sikanowski, he just wanted a better canoe, right? So he starts building them in his dad's garage.
Yeah, and it grows into this, major company.
Exactly. And it just shows even something so hands-on, it still comes down to, well, basic business ideas, how you track things, how you decide things.
Uh-huh. And that's really what we're diving into today.
Welcome to the deep dive.
So we've got these excerpts from a managerial accounting textbook, Wygant, Kimmel, and Kiso. Good stuff. Our goal here is to pull out the really important bits for you.
Yeah, the core knowledge, how businesses actually track their costs and make decisions without you needing, a CPA.
We just want you to get the key insights, the practical understanding.
Right. So our mission today, make managerial accounting make sense. We're going to look at how companies sort their costs, what's part of making the product versus just running the show.
And the systems they use to track all that spending. We'll even touch on things like ethical incentives, which is pretty interesting.
Definitely. And knowing Don Chioso's background, this stuff is grounded in how things really work. So you ready to jump in?
Let's do it.
Yeah.
Okay, first big thing we need to get our heads around is this difference between product costs and period costs. It's like foundational.
Okay.
So the textbook says product costs are basically everything necessary and integral to actually producing the finished product.
Like the actual stuff you use.
Exactly. Direct materials, the wages of the people physically making it, that's direct labor, and then all the other factory stuff, manufacturing overhead.
Right, that overhead bucket.
And the key thing, these costs, they don't hit the expense sheet right away. They sit on the balance sheet as inventory first.
Okay, so for those terrain park snowboards the book talks about, the wood, the fiberglass, that's direct materials.
Yep.
The people assembling the boards, their wages are direct labor.
Right.
And then overhead is, well, everything else at the factory, like the electricity, the machines wearing out, the factory manager salary.
You got it. The book lists examples like $25,000 depreciation on vacuum machines, $6,000 property tax on the factory building, $45,000 for maintenance folks, $70,000 for the plant manager, all that stuff.
And it only becomes an expense, the cost of goods sold, when the snowboard actually sells.
Precisely. That's the crucial timing difference. Now, flip side, period costs.
Okay.
These aren't tied to making the product itself. They're matched with the specific time period. Think non-manufacturing costs.
Like selling the stuff, running the office.
Exactly. Selling and administrative expenses, S&A costs. The textbook points to advertising, sales commissions, shipping costs, those $60,000 a year for ads, $20 commission per board, $8 to ship each one for terrain park.
Those happen whether they make another board or not, right? They're tied to the month or the year.
Spot on. They hit the income statement in the period they happen. The book has some visuals, illustrations 1.4 and 1.5, that kind of lay this out. It even mentions the total manufacturing cost for 10,000 boards was $846,000.
And that solution table you mentioned breaks it down even more.
Yeah, it does. It clearly shows things like rent on the manufacturing gear, insurance on the factory building, raw materials, factory utilities, assembly wages, all product costs.
Falling into materials, labor, or overhead.
Right. And then it correctly flags things like office supplies or depreciation on the office equipment as period costs. Getting this split right is vital. It impacts everything. Pricing, strategy, you name it.
Okay, makes sense. Product costs to make it, period costs to sell it and run the business. So how do companies actually, track all this in a structured way?
Good question. That leads us to cost accounting systems. The book highlights two main types: job order costing and process costing.
Job order sounds like it's on specific jobs.
Exactly. You use it when you're making unique items or batches. Each job is different. The textbook uses Disney making a specific movie as an example.
Oh, right. Like each film is its own project.
Or General Motors making a custom limo. For each distinct job, they track the materials used, the labor spent, and the overhead applied specifically to that job.
So they'd have like a separate sheet for each movie tracking costs.
Pretty much. The book calls them job cost sheets.
Yeah.
All the costs pile up there in what's called work-in-process inventory until the job's done. They use things like materials requisition slips to track which materials went to which job. Illustration 2.2 kind of shows this for Disney.
Okay, that works for unique stuff. But what about companies churning out thousands of identical things, like regular cars?
That's where process costing comes in. Perfect example from the book is GM's standard models, like a Chevy.
Right, not the custom limo, just the regular ones off the line.
Exactly. With process costing, you don't track costs for each individual car. Instead, you gather up all the manufacturing costs for a period, say, a month, and then you just spread those costs evenly over all the identical units you produce that month.
So you average the cost across the whole batch.
Basically, yes. Whether it's job order or process costing, the goal is the same, as the book points out.
To get that cost per unit.
Right. You need that unit cost info for setting prices, controlling expenses, valuing your inventory, and putting together your financial statements. It's critical information.
Okay, got it. Job order for unique, process for mass production. Let's dig into that overhead piece again. It still feels a bit fuzzy. How do they actually assign it?
Yeah, it can be tricky because it's indirect. You can't easily trace it, like materials or labor. So companies often use what's called a predetermined overhead rate.
Predetermined, so they guess beforehand.
Well, it's an estimate, yeah. Calculated at the start of the period. They estimate their total overhead costs for the upcoming period, and then they estimate some activity level, like how many hours of direct labor they expect, or total direct labor cost.
And divide one by the other.
Exactly. Total estimated overhead divided by the total estimated activity base. That gives you a rate. The dorm decor example in the book applies overhead at like 50% of direct labor cost.
So for every dollar they plan to spend on labor, they tack on 50 cents for overhead.
That's the idea. It's a way to allocate those indirect costs to the products as they're being made. But here's the catch.
It's based on estimates.
Right. So the actual overhead costs hardly ever match exactly what was applied using that rate. You end up with either underapplied or overapplied overhead.
Meaning you guessed too low or too high.
Essentially, yes. Underapplied means actual costs were higher than what you applied to jobs. Overapplied means actual costs were lower. Illustration 219 shows this difference.
And the Disney example comes back here too, right? Making films costs a ton, materials, labor, all sorts of overhead.
Huge costs.
And if they figured out a specific documentary, G408, costs $100,000 to make, and their strategy is to price it 50% above cost.
Then getting that $100,000 cost number right, including a fair share of that applied overhead, is absolutely vital for hitting their profit target. If the overhead allocation is off, the whole pricing model is skewed.
Yeah, you could underprice and lose money, or overprice and nobody buys it.
Exactly. The book mentions other jobs too, A16 and B17, just showing how materials, labor, and that applied overhead all feed into the final job cost.
This cost tracking stuff feels so mechanical almost. But the book brings up the human side too, the ethics involved.
That's a really important detour, because these systems we use to monitor and evaluate performance, they can sometimes create unintended incentives, pressure to act unethically.
How so?
Well, think about it. If a manager's bonus is tied super tightly to hitting a budget number, what might happen?
They might fudge the numbers, cut corners they shouldn't.
Exactly. They might game the system. The book gives the example of Boeing after the McDonnell-Douglas merger.
What happened there?
Some insiders felt the new evaluation systems pushed this win-at-all-costs culture. And that was linked by some to later ethical lapses, like issues with billing or even allegations of corporate espionage.
Wow. That's serious.
It is. And it's not always about money directly. Look at the sharing plow example.
The drug company.
Yeah. The focus was so intense on hitting production quantity targets that quality control apparently slipped. They ended up with issues like wrong dosages in medications.
That's terrifying. So the metrics you choose can really drive behavior, for better or worse.
Absolutely. It highlights how critical it is to think through the potential consequences of your incentive systems. It's a delicate balancing act. You need to measure performance, but you don't want to accidentally reward bad behavior.
Right. Speaking of management, the book also clarifies a couple of key roles in the finance department, the CFO and the controller.
Yeah, important distinction. The CFO, Chief Financial Officer, that's the top dog, responsible for all financial and accounting matters in the company.
Big picture stuff.
Right. Then, often reporting to the CFO, you have the controller. Their job is more hands-on with the accounting operations, maintaining the records, making sure internal controls are working, preparing the financial statements, tax returns, internal reports.
So CFO is strategy, controller is operations and reporting.
That's a good way to put it. They work closely together, obviously, but have distinct areas of primary responsibility, both vital for keeping the company financially sound and transparent.
Okay, so we know about costs, tracking them, some pitfalls. How does it all come together to show what it actually costs to make the stuff that got sold?
Okay, now we're talking about the cost of goods manufactured and cost of goods sold schedules. These are key summaries.
Right.
The cost of goods manufactured schedule calculates the total cost of everything that was finished and moved from the factory floor or work in process inventory into the warehouse, or finished goods inventory during a period.
How does it do that?
You start with the value of the partially finished goods you had at the beginning of the period. So it's a beginning work in process.
Okay.
Then you add all the manufacturing costs you incurred during the period. Direct materials used, direct labor paid, and all the manufacturing overhead applied.
Got it.
Then you subtract the value of the partially finished goods you still have left at the end of the period ending work in process. What's left is the cost of the goods that were actually completed.
So beginning WIP plus current manufacturing costs, ending WIP equals cost of goods manufactured.
Perfect. That number represents the cost of products that are now ready to be sold.
And then the cost of goods sold.
That builds on the cost of goods manufactured.
Mm.
You take the value of the finished good you had ready to sell at the start of the period beginning finished goods inventory.
Okay.
Add the cost of goods, manufacture the cost of newly finished goods. That gives you the total cost of good available for sale.
Makes sense.
Then subtract the value of the finished goods you didn't sell,
Okay.
the ones still in the warehouse at the end of the period ending finished goods inventory. The result is the cost of goods sold. That's the number that goes on the income statement as an expense.
Beginning finished goods plus cost of goods manufactured, ending finished goods, cost of goods sold.
You nailed it. The Superior Company example in the book walks through this with actual numbers, showing how you'd compute both.
It feels like these methods have been around a while. Does the book mention newer approaches too?
It does, yeah. Managerial accounting keeps evolving. It briefly touches on things like activity-based costing, or ABC.
What's that?
It's a more sophisticated way to allocate overhead. Instead of using one plant-wide rate, it tries to link overhead costs to the specific activities that actually drive those costs, giving potentially more accurate product costs.
Interesting. What else?
It also mentions just-in-time inventory, JIT, which is all about minimizing inventory levels to reduce waste and storage costs. Then there's the balanced scorecard.
We mentioned that briefly, looking beyond just financials.
Right. Incorporating customer perspectives, internal processes, learning and growth, and also value chain analysis, which looks at costs across the entire chain of activities from R&D to customer service. Exercise E118 references these.
So lots of tools in the modern toolkit.
Definitely. Always looking for better ways to understand and manage costs and performance.
Let's look at another example the book uses, Con Products Company. They had some kind of conflict, didn't they?
Yeah, a classic one. They made the seasonal product, TC1, using job order costing. The problem was the unit costs seemed to bounce around a lot from quarter to quarter.
And that caused issues.
Big time. The sales team was tearing their hair out because the fluctuating costs meant they had to keep changing the selling price. Customers weren't happy, they lost some sales.
But production felt they were doing it right.
Production was like, hey, we're just tracking the actual costs for each batch we run. The data showed big swings in materials, labor, and especially overhead per unit across the quarters.
So what was likely causing those swings in unit cost if the product is the same?
Well, the question the book poses points towards fixed manufacturing overhead. Think about it. Things like factory rent or the plant manager's salary. Those costs are generally the same total amount each quarter, right?
Yeah, usually.
But if you produce fewer units in a slow quarter, you're spreading that same fixed cost over a smaller number of units, so the cost per unit goes up.
Ah. And in a busy quarter, you make more units, so the fixed cost per unit goes down.
Exactly. So the exercise asks you to think about solutions. How could Con products maybe stabilize those unit costs for better pricing consistency? It's a common challenge.
It really shows how accounting choices impact other departments, like sales. There was another customer scenario, too, with Williams Company, Nancy Copay.
Right, BYP24. Nancy got a custom carpentry job done. She looked at the bill, saw the breakdown for direct materials and direct labor totally clear.
But the overhead part.
That was shown as an estimated amount. And she was curious, what's actually in this estimate? Why isn't it exact like the materials?
Big question.
It really highlights the communication aspect. How much detail do you share with customers about overhead allocation? It's based on estimates, as we discussed, so it can't be perfectly precise at the time the job is costed. It raises questions about transparency.
Yeah, definitely something businesses have to navigate. And then Jones Soda, the company with the crazy labels and all the flavors.
Huh, yeah.
Hmm.
Funky brand. But the point the book makes is, despite their unique marketing, they're in a tough market.
Beverages are competitive.
Super competitive. And with what the text calls a dizzying array of product variations, well, cost control becomes absolutely critical.
They need to know if that weird bacon-flavored soda is actually making money.
Pretty much. They have to understand the cost of each flavor, each package size, to price them right and make sure they're profitable overall. It shows that even for creative, seemingly non-traditional businesses, these managerial accounting principles are essential.
Okay, these examples really help. Let's shift focus a bit. How do businesses use this cost information to make specific choices? Like, should we accept this order or replace that machine?
Right, that's where incremental analysis comes in, Chapter 7 territory. The core idea is simple. Focus only on the costs and revenues that will change as a result of your decision.
The ones that are different between your options.
Exactly. Those are the relevant costs and revenues. Anything that stays the same, no matter what you decide, ignore it. It's irrelevant to the decision. Illustration 7.2 shows this basic compare the differences approach.
So you cut through the noise and just look at what changes.
Precisely. And a key type of relevant cost the book emphasizes is opportunity cost.
What you give up.
The benefit you forego by choosing one alternative over another, that's always relevant. And conversely, sunk costs.
Money already spent.
Yeah, costs already incurred that you can't get back. Totally irrelevant to future decisions. You can't change the past.
Okay. So like the example of accepting a special order at a lower price.
Right. Illustration 7.4. The relevant costs are just the additional variable costs to make that extra batch, materials, labor, variable overhead. You ignore fixed costs because they wouldn't change.
Assuming you have the spare capacity and it doesn't mess up your regular sales.
Key assumptions, yes. And deciding whether to keep old equipment or buy new. Illustration 7.15 covers that.
And the old machine's book value, what it's worth on the accounting records. That's irrelevant.
Totally irrelevant. It's a sunk cost. What matters is the cost of the new machine, what you can sell the old one for now, its salvage value, and how the operating costs like repairs, energy use will differ between keeping the old and getting the new.
People get hung up on sunk costs, though, don't they? Like, we just spent money fixing that old thing.
Oh yeah, the sunk cost fallacy is powerful. But financially, past spending doesn't justify future spending if a better option exists.
What about deciding whether to make something yourself or just buy it from someone else? Make or buy decisions.
Same principle. You compare the relevant costs of making it internally direct materials, direct labor, variable overhead, plus any fixed overhead you could actually avoid if you stop making it.
So not all fixed overhead, just the avoidable part.
Right. Compare that total relevant cost of making it to the purchase price from the outside supplier. The method dispenser example and the Pottery Ranch finial example illustrate this.
And you also have to think about opportunity costs there too, right? If buying frees up your machines.
Exactly. If you could use that freed up capacity to make something else profitable, the profit you'd make on that other product becomes an opportunity cost of continuing to make the original component. It counts in favor of buying. And of course, qualitative factors matter too. Supplier reliability, quality.
Okay, incremental analysis for specific choices. How about setting prices in the first place? The book mentions cost plus pricing.
Yeah, Chapter 8. It's a pretty common starting point. You figure out the cost to produce something, then you add a markup percentage to arrive at the selling price.
Cost plus markup equals price. Seems simple enough.
It is, conceptually. Illustration 8.9 shows calculating the markup, and 8.10 shows getting the selling price. The markup is supposed to cover your operating expenses and give you a profit.
But there are downsides.
Big ones. The main limitation is it pretty much ignores the customer and the market. What if the price you calculate based on your costs is way higher than what customers are willing to pay?
You won't sell much.
Right. And it also struggles with fixed costs. Your cost per unit depends heavily on how many units you actually sell. If volume drops, your fixed cost per unit goes up, and that nice markup might disappear or even turn into a loss if you don't adjust the price.
So it's a starting point maybe, but not the whole picture.
Exactly. Another interesting pricing topic in that chapter is transfer pricing.
That's pricing between divisions inside the same company.
Yep. Like the boot division buying soles from the sole division, in the book's example. What price should the sole division charge the boot division?
Can't they just charge them what it costs to make the soles?
Sometimes, but it depends. The book talks about the minimum transfer price the selling division, sole division, should accept. And that depends on whether they have spare capacity.
How so?
If the sole division is already selling everything it can make to outside customers at a profit, then selling internally to the boot division means giving up those outside sales.
An opportunity cost again.
Right. So the minimum price has to cover their variable cost, plus the contribution margin they lose from the outside sale. That's shown in illustration 8.18.
But if they have extra capacity, machines sitting idle.
Then there's no opportunity cost of lost external sales. In that case, The minimum transfer price might just be the variable cost of making the soles. The goal is to set a price that benefits the company as a whole, encouraging efficient decisions between divisions.
Okay, that makes sense. Let's shift to looking ahead planning. Chapter 9 is all about budgeting, right? Why is that such a big deal for businesses?
Well, planning is just fundamental to good management. And a budget, as the book says, is basically management's plan written down in financial terms for a specific future period.
So it's a roadmap.
Exactly. It communicates goals, allocates resources, and importantly, it sets a benchmark, something you can later compare actual results against to see how you did. It helps coordinate activities and uncover potential problems early.
Is there one way to do budgeting?
Not really.
Hmm.
The book discusses participative budgeting, sometimes called bottom-up.
Where managers at lower levels provide input.
Yeah. The ideal is it can lead to more accurate budgets because those managers are closer to the action, and it might increase their commitment to meeting the budget. Illustration 9-1 touches on that.
Sounds good. Any downsides?
Can be more time-consuming. And there's the risk of budgetary slack.
Meaning?
Managers might build in a cushion, underestimate revenues, or overestimate costs to make their targets easier to hit.
Gaming the system again.
Potentially. That's why the book stresses that strong support from top management is crucial. Budgets need to be seen as a serious planning and coordination tool, not just a way to pressure people.
And all these individual budgets roll up into one big one, the master budget.
Correct. The master budget coordinates everything. It's made up of several operating budgets and financial budgets.
Operating budgets. Like sales, production?
Right. Sales budget usually comes first. Then production budget, how much you need to make. Then direct materials, direct labor, manufacturing overhead budgets, what resources you need for that production. And also a selling and administrative expense budget for non-manufacturing costs.
And the financial budgets.
Those include things like the capital expenditure budget for big asset purchases, the all-important cash budget, and finally, the budgeted balance sheet, showing the expected financial position at the end of the period.
You said the sales budget usually comes first.
Yeah, it's typically the cornerstone. You forecast your sales units times selling price. The Hayes Company example in illustration 9-3 shows this. That sales forecast then drives the production budget.
How many units you need to make.
Exactly. Expected sales plus however many you want left in ending inventory minus what you already have in beginning inventory. That tells you your production target.
And that tells you how much material, labor, and overhead you'll need.
Precisely. The direct materials budget calculates the quantity and cost of materials needed for production. The direct labor budget figures out the hours and cost of labor. The manufacturing overhead budget estimates all those indirect factory costs, often splitting them into variable and fixed components, like in illustration 9-9 for Hayes Company. Then the S&A budget plans for the non-factory costs.
And all that feeds into a projected income statement.
Yep. The budgeted income statement shows the expected profitability based on all those operating budgets.
What about the cash budget? That sounds critical.
Oh, it is. Maybe the most critical short-term budget. It forecasts all your expected cash inflows, cash sales, collecting from customers, and all your expected cash outflows, paying suppliers, employees, covering overhead, buying assets, paying loans.
To make sure you don't run out of cash.
Exactly. It shows if you'll have enough cash, or you need to arrange financing, or if you'll have excess cash you could invest. Illustration 9-14 gives the basic layout: receipts, disbursements, financing, and the resulting cash balance.
So budgeting is this whole interconnected cycle of planning. What happens after the period is over? You just make a new budget.
Well, you do make new budgets, but first comes control. That's chapter 10, budgetary control. It's about comparing what actually happened with what you planned in the budget.
Finding out where things went right or wrong.
Exactly. Management gets budget reports that compare actual results to the budgeted figures. This helps identify problem areas, evaluate performance, and take corrective action. Illustration 10-1 shows this feedback loop.
But wait, if your actual sales volume was way different from the budget, is comparing actual costs to the original budget really fair?
Excellent point. That's the limitation of a static budget, one prepared for just a single planned level of activity. It works okay for fixed costs, but not so well for variable costs if your activity level changes.
So what's the alternative?
Flexible budgets. These are budgets designed to adjust or flex based on the actual level of activity achieved.
How does that work?
You basically figure out the formula for your costs, how much is fixed, and how much varies per unit of activity, like per unit produced or per machine hour. Then at the end of the period, you plug in the actual activity level into that formula to calculate what the costs should have been for that level of output.
Ah, so you're comparing actual costs to what they should have been for the actual work done, apples to apples.
Precisely. It gives a much better basis for evaluating cost control, especially for variable costs.
The chapter also talks about responsibility accounting.
Yes, that's about structuring performance evaluation around management responsibility. The key is focusing on what a specific manager can actually control.
So you don't hold someone accountable for costs they have no influence over.
Right. Responsibility reports are tailored for different levels. Cost centers, managers control costs. Profit centers, managers control revenues and costs. And investment centers, managers control revenues, costs, and the assets used.
And they use different metrics.
Yeah. For profit centers, you might look at controllable margin contribution margin minus controllable fixed costs. For investment centers, common measures are return on investment, ROI, or residual income, which factor in the profitability relative to the assets employed.
Okay, so budgets help plan and control. But how do companies set the targets within those budgets? Like, what should a unit cost?
Now you're getting into standard costs, which is Chapter 11. Standard costs are predetermined or target unit costs. They represent what a unit should cost under efficient operating conditions.
Like a benchmark.
Exactly. The book notes in illustration 11:1 that standards help with cost control, performance evaluation, inventory evaluation, and even simplifying bookkeeping. They're different from budgets, though.
How so? Budgets are total, standards are per unit.
You got it. A budget might say total direct labor cost will be $50,000. A standard would say direct labor should be $10 per unit.
And that standard cost has pieces.
Yep. Usually a standard cost per unit is built from a standard quantity of direct materials allowed per unit times a standard price per unit of material. A standard number of direct labor hours allowed per unit times a standard rate per hour. And a standard overhead rate applied based on a standard amount of the activity base, like labor hours, allowed per unit. Illustration 11.3 and 11.6 show this breakdown.
So you have a target for both how much input you should use, quantity efficiency, and what you should pay for it, price or rate.
Precisely. And then you compare actual results to these standards. The differences are called variances.
Favorable or unfavorable?
Right. If actual cost is less than standard, it's favorable. F. If actual cost is more than standard, it's unfavorable. These variances signal where performance differed from the plan, prompting investigation.
And the balanced scorecard fits in here too.
Yeah, the book brings it up again as a way to have a broader perspective than just cost variances. It pushes companies to measure performance across financial, customer, internal process, and learning growth dimensions, linking everything back to strategy.
Okay, that covers a lot of the operational side. What about those really big long-term decisions? Buying major equipment, launching a whole new factory.
Capital budgeting. That's Chapter 12. It's the whole process companies use to analyze and select investments in long-term assets. Huge decisions, often involving lots of money and impacting the company for years. Illustration 12:1 outlines the process.
And these decisions hinge on future cash flows, not just accounting profit.
Absolutely critical distinction. Capital budgeting focuses on the actual cash inflows the investment is expected to generate over its life and the cash outflows required to make the investment. Why? Because cash is what you use to pay bills, repay debt, and reward shareholders.
So things like depreciation. They matter for taxes, but not directly for the cash flow calculation itself.
Right. Depreciation is a non-cash expense. You often add it back to net income to help estimate the project's cash flow, as the book explains. Illustration 12.2 lists typical cash inflows and outflows for these kinds of decisions.
And there are different techniques to evaluate these potential investments.
Yes, several. The book covers the cash payback period.
How quickly you get your initial money back.
Yeah. Simple to calculate, gives you a sense of risk and liquidity. But its big weakness is it ignores cash flows after the payback period, and crucially, it ignores the time value of money.
Meaning $1 today is worth more than $1 next year.
Exactly. That's where discounted cash flow, DCF methods come in. They do consider the time value of money. The two main ones are net present value, NPV, and internal rate of return, IRR.
NPV. That sounds like comparing the present value of the benefits to the present value of the costs.
Spot on. You discount all the expected future cash inflows back to their present value using your required rate of return, often the company's cost of capital, and subtract the present value of the cash outflows, usually the initial investment. If the NPV is positive, the project is expected to generate more value than it costs, so it's generally acceptable. Illustration 12.13 shows an example.
An IRR.
Internal rate of return finds the specific discount rate at which the project's NPV equals 0. It represents the project's expected percentage rate of return. You then compare this IRR to your required rate of return. If IRR is higher, the project looks good. Illustration 1221 has an example.
Which method is better?
The book, like most finance texts, generally favors NPV because it directly measures the expected increase in value to the firm, and it handles unconventional cash flows better than IRR sometimes does.
Okay, moving towards the end here. Chapter 13 looks at the statement of cash flows. We've talked about cash flows a lot. What's the purpose of this specific statement?
It's one of the main financial statements, alongside the balance sheet and income statement. Its whole purpose is to show where a company's cash came from inflows and where it went outflows during a specific period.
And it breaks these flows down.
Yes, into 3 standard categories. Operating activities cash flow from the main day-to-day business operations. Investing activities cash flow from buying and selling long-term assets like equipment or buildings. And financing activities cash flow related to debt, equity, and dividends.
So you can see if the company is generating cash from its core business or if it's relying on borrowing, for instance.
Exactly. It gives insights into liquidity, solvency, and financial flexibility that you might not get just from the income statement.
The book mentions direct and indirect methods for the operating section.
Right. Just 2 ways of presenting the same operating cash flow number. The indirect method is more common. It starts with net income and adjusts for non-cash items like depreciation and changes in working capital accounts like inventory or accounts receivable. The direct method shows actual cash receipts from customers and cash payments to suppliers, employees, etc.
And there's something called free cash flow.
Yeah, that's a measure analysts often look at. It's basically cash flow from operations minus the cash needed for capital expenditures to maintain and grow the business, and usually minus dividends. It represents the cash available for other things, paying down debt, making acquisitions, share buybacks. Illustration 1316 shows a calculation.
Okay, last stop. Chapter 14, financial statement analysis. We have all these statements, now what?
Now you analyze them. The goal is to evaluate the company's past performance and current financial position to make judgments about its future prospects. Useful for investors, creditors, managers, everyone.
And you need something to compare the numbers to.
Definitely. Analysis needs context. The book mentions 3 bases. Intra-company, comparing the company to its own past performance, looking for trends. Industry averages, comparing to competitors in the same sector. And inter-company, comparing directly to 1 or 2 specific peers.
What are some of the main tools for analysis?
2 key techniques are horizontal analysis and vertical analysis.
Horizontal, looking across time.
Yes. Calculating the percentage change in accounts from one period to the next helps spot trends. Illustration 14-5 shows this.
And vertical.
That's looking within a single statement for a single period, expressing each item as a percentage of a key base amount. Like on the income statement, every item as a percentage of net sales. Or on the balance sheet, every asset as a percentage of total assets shows the relative importance of items. Illustration 14-9 has an example.
And then there are ratios, right? Lots of ratios.
Oh yeah, ratio analysis is huge. The book groups them into categories. Liquidity ratios, like the current ratio or asset test ratio, measuring ability to meet short-term debts. Profitability ratios, like profit margin, return on assets, return on equity, measuring earning power. And solvency ratios, like debt to assets, measuring ability to survive long-term and pay long-term debt.
And the book gives examples like illustrations 1415, 1419, 1421.
Exactly. It walks through calculating and interpreting many key ratios. It also touches on market-based ratios like earnings per share, EPS, and the price earnings, PE ratio, which investors use heavily. Illustration 1423 mentions these.
Wow. Okay. That was definitely a deep dive into managerial accounting, from basic cost types all the way to analyzing the big picture financial statements.
We covered a lot of ground, for sure. And hopefully you can really see now how these concepts, which might seem purely internal, actually drive so much of what a business does.
Yeah, understanding costs, having good systems, using the right tools for decisions. It clearly affects strategy, profit.
Even ethics, as we saw with the Boeing and Sharing Plow examples, it matters whether you're talking about Winona Canoe starting small, or a giant like GM, or a niche player like Jones Soda. These principles apply across the board.
So maybe something for you, the listener, to think about. How might some of these ideas apply in your world, even personally?
Yeah, could thinking about relevant costs help you make a decision between 2 options? Could a simple budget give you more control over your own finances?
The principles have broad application, really.
They do. And if any specific area caught your interest, maybe activity-based costing or capital budgeting, we'd encourage you to dig a little deeper. Look up those companies, explore the topics more. There's always more to learn.
Absolutely. Well, that wraps up this deep dive. Thanks so much for joining us.
Yeah, thanks for listening.
We'll catch you next time for another exploration.